Okay. Yeah, so hello everybody, first of all from me. Yeah, as Armin said, I'm a PhD candidate at Maastricht University. And here in the background, you can also see a picture of the Friedhof in Maastricht. So if you haven't been there, it is definitely worth a visit. A bit dark in this picture, but yeah, it's a very nice place. And the paper that I'm presenting is together with Paul Smeets, who's also at Maastricht University, and then with Utz Weitzel, who is at Radboud University in Nijmegen and the VU in Amsterdam. And yeah, as was said before, the paper has the title, Do Financial Advisors Exploit Responsible Investment Preferences? And Mechthild already said she fears that they do. So let's see what we found out. So first of all, what is the paper based on? So there's a forthcoming regulation by the European Commission, according to which financial advisors and financial asset managers have to ask their clients, do you want to give me a mandate for investing sustainably? And on the one hand, this could be good news, because this may mean that there might be higher demand for sustainable investments. And because of this, on the other hand, there are financial regulators, for example, the ESMA, who are responsible for investor protection. And they published a report in which they say, yeah, we are a bit scared that because of this regulation, financial advisors may take this knowledge on whether or not their clients want to invest sustainably to sell their own products or to sell more costly ones. And this concern is sort of in line with a recent article in the Wall Street Journal, which says, there's more and more investors who want to invest sustainably, and they're willing to pay higher fees for investing sustainably. And this is a great opportunity for asset managers, because they can earn much higher fees in an industry with falling fees, with little more costs and effort to themselves. Also in the report from the ESMA, they included the outcome of a survey that they ran with asset managers. And their asset managers said, yeah, we don't think that this is actually a problem. We don't see any conflicts of interest in practice, and don't think that any exploitation is going to take place. So who's right? So that is sort of the research question that we considered in our study. So do client mandates for SRI affect the quality and cost of financial advice? And then specifically, do advisors charge higher fees to clients who give an SRI mandate? So SRI here, socially responsible investing, which I'm using interchangeably with sustainable investing. Then if yes, are these higher fees a compensation for maybe more skills? So maybe asset managers in SRI are more skilled than those who are not in SRI, or is it a compensation for more effort? Or is this really an exploitation of the preferences of individual investors? So how did we do this? We ran an experiment, and we ran this experiment with actual financial asset managers, actual financial advisors and asset managers in the US. So total, we had 345 financial advisors in the US. I will later talk a bit more about who exactly those people were. And then we allocated them to clients, and we tried to design our experiment to mimic the natural decision environment of these financial advisors and clients. And the experimental design consisted of 2 stages. In the first stage, we have the advisors who see a client profile with some information about this client, including, does this client want to invest socially responsible or conventionally? And they then selected a stock portfolio on behalf of this client. and then set an advisory fee for their service of advising a certain stock portfolio. I will in a bit show a bit more how exactly this looked like. And then in the second stage, the clients had the option, do you want to now pay the fee? And in that case, you will get the advice, or you don't pay the fee and then you don't get the advice, but instead you have to select stocks for yourselves. And we used it within advisor design, meaning that each advisor saw 4 different client profiles. Yeah, we then saw, does the same advisor charge a different fee to different clients depending on characteristics such as the sustainability mandate. So here an example of what the decision screen might have looked like. So on the left, you see the client profile. So this is client 1 out of 4 that the advisor saw. You see the gender, age, the income, and then the risk profile. So here the risk profile, that was always the same for all clients. It was always at aggressive, and aggressive meant they wanted to invest 100% of their budget into stocks. And then we see the investor mandate, which in this case was socially responsible. And on the right side, we see an extract of the portfolio allocation screen. Yeah, here it's just an extract. So in total, there were 30 stocks. So those were all 30 stocks of the Dow Jones Industrial Average. And the weights of each stock in the portfolio were by default set to the weight that is in the Dow Jones currently. But then the advisors could drag these bars to increase or decrease the weight of each stock for their client. The advisors could also click on the name of a company to get more information on this company, including information on the sustainability of this company. So those were two scores that we showed. First of all, the ESG rating from MSCI. So in this case, this is a BBB, which is color-coded in yellow, which stands for average in the MSCI rating. And then the second SRI score that we showed was whether or not the company was a participant of the United Nations Global Compact. And then this is the main decision screen. So what we were mostly interested in. So this is then the fee that the advisors set after they put together the portfolio for their client. So they could set the fee between anything between 0 and 4%. So the implementation, yeah, as I said before, we ran the study in the US with financial professionals. So exactly were these financial professionals? First of all, we had 345 professional advisors. Because, as I said before, each advisor was allocated to 4 clients. We ended up with 1,380 advisor-client relationships. And yeah, these advisors work either for banks or for insurance companies. And the regulation from the European Commission also counts for banks and insurance companies. And their job involves, to some extent, an advisor-client relationship. And as an example, we included private bankers, investment advisors, or portfolio managers, and we excluded, for example, IT support, auditors, or those working in corporate finance. Yeah, the decisions were consequential. So the stocks that were selected by the advisors were actually bought on the market with a probability of 10%. So why is this important? Because because we actually bought the stocks, there were actually negative consequences from selecting stocks that are socially irresponsible or non-sustainable. Okay, so to the results. So the first question we had was, do these financial advisors actually create more socially responsible portfolios when the client gives a social responsibility mandate? What we found was, in short, yes, they do. So as I said before, we showed two different scores for social responsibility. So first of all, does the company participate in the United Nations Global Compact? What is the MSCI ESG score of the company? And we had different ways of quantifying these indicators that we show, but no matter which measure we used, we always came to the conclusion when there's a client that gives a social responsibility mandate, then the advisor created a more sustainable portfolio for the client. So that is first of all good news. So then that means that the clients can delegate their sustainability preferences. But now we come to the question at what costs. So here we looked at, here we had the advisory fee as a dependent variable. What we see is that when a client gives a sustainability mandate, then the advisor charged a higher fee of 4.9 basis points. Which is a statistically significant at the 5% level. And we also see that there's no other client characteristics which explain differences in fees. So what is especially interesting here is gender, for example, because there's also studies that show that there might be price discrimination against females in some financial markets. Which we do not find here. So this is also an interesting side finding that we have here. What we have here is the within advisor differences in fees. So what we can already say here is that these differences cannot be due to differences between advisors. So for example, we can rule out here the explanation that I had in the beginning. Maybe those who are in SRI are more skilled than those who are not in SRI. So this cannot be the case here, and this cannot explain the differences in fees. So what else could explain differences in fees? That there's a difference in effort. So here we measured effort in terms of, first of all, how much time did the advisors spend to create the portfolios for their clients? And two, how often did they click, for example, by changing the weights or by opening the pop-up boxes with information about the stocks. And here we find no differences in terms of the time and the number of clicks, whether the client gives an SRI mandate or gives a conventional mandate. The last thing we did was, we ran an experiment. And the problem with experiments is always, it's an abstraction of reality. So we try to design it to mimic as closely as possible the actual decisions taken by advisors. But we were still interested, okay, how much can we infer from this now for real financial markets? So we ran a survey with regulators. Among these regulators are also those, or some of them, that are responsible for the European Commission regulation that I was talking about before. And we asked them, do you believe that the findings from our research study are informative about the behavior of financial advisors in the field? And interestingly, most of the participants thought that they believe that our experiment is actually informative to some extent about the actual behavior in the field. And then the second question that we asked was, do you think that our results require attention from regulators? And also there, the majority of 82% stated that they think yes, these results require attention from regulators. And then we asked them, what do you think would be a suitable policy intervention? And we had two research assistants in Maastricht that categorized the responses given by the regulators. Those that were most frequently mentioned was transparency. We need more standardization of fees, and we need more consumer education. So maybe that comes back again when we talk about sustainable financial literacy in the next talk. But we are also currently in a follow-up project trying to think of ways to integrate these things to try to avoid negative side consequences from giving the social responsibility mandate. So yeah, in conclusion, we found that advisors charge a premium to clients with an SRI mandate, and that this premium is not justified by additional services, and that this is a potential unintended side consequence of the upcoming EU regulation that will require financial institutions to measure client sustainable investment preferences. And then third, we find that European regulators largely believe in the external validity of our findings, and they see the necessity of policy intervention. If you're interested in the topic, we have, and in the full working paper, you can either find it online or you can contact me directly. The email address is here, so you can also contact me if you have feedback on the study or on the paper. I'm always looking forward to that. And yeah, thanks very much.